This initiative, the president said, is crucial for fostering economic growth and enhancing bilateral relations between the two West African nations. The president made this declaration during a press briefing after a meeting with Mali's transitional president, General Assimi Goïta, in Bamako. The discussions focused on streamlining trade procedures, eliminating bureaucratic bottlenecks, and enhancing cooperation between the two countries' transport and custom agencies.
We discussed issues of how we can strengthen our defense cooperation in the light of the fight against terrorism.
Across deserts and rainforests, on artisanal pits and industrial concessions, a new surge is underway, a gold rush that is transforming Africa's economies and reverberating through the global financial system. What was once the quiet of miners and market stalls has become a force reshaping central bank strategy, investor flows, and the balance of global reserves. Tonight, we ask, how is Africa's gold boom shaking the world? And who stands to gain? For centuries, gold has been a silent partner to global finance, backing coins, calming markets, and acting as an insurance policy in times of crisis. In the last decade, demand for gold has shifted away from simple vestiges of the past to a modern tool of stability. Central banks, ETFs, and strategic reserves now buy in large quantities. Now, the source of that gold is changing. Recent production data show Africa producing more gold than any other region, over 1,000 tons annually in the most recent tallies, with countries like Ghana, Mali, and South Africa among the continent's largest producers. Ghana, in particular, has become a leading light, producing roughly 140 tons in the latest reports and overtaking markets long thought to be dominant. This is not an isolated uptick. It is a structural shift from low-volume artisanal supply toward industrial-scale output that can actually move global markets. At the same time, the price of gold has surged. In 2024 to 2025, the market witnessed sustained rallies, driven by safe haven demand, monetary policy shifts, and a renewed appetite from official institutions. As geopolitical tensions rose and interest rate expectations shifted, gold reclaimed its status as a global refuge, and central banks resumed buying. Central banks, from the established economies to an increasing number of African monetary authorities, have been adding gold to reserves. For many African central banks, the logic is simple: diversify reserves, hedge against currency shocks, and increase economic sovereignty. The result is a dual trend: rising production in Africa and rising demand globally, creating a new price dynamic and global attention on the continent's minds. When global buyers look for secure, certified supply, they look to where the gold is produced and how it is mined. That makes the provenance of African gold an issue of financial and geopolitical consequence. The geography of Africa's gold story is broad. West Africa, notably Ghana and Mali, has surged as a production leader. East and Southern Africa host both world-class mines and emerging frontier operations. South Africa, once the uncontested king of gold, has restructured its industry and remains a significant high-grade producer. But the landscape is mixed. Large multinational mining firms operate alongside millions of small-scale and artisanal miners. While industrial operations bring scale, artisanal communities supply a meaningful share of local markets, and often do so with minimal oversight. The coexistence of these two worlds raises questions of regulation, tax capture, and environmental governance. In the end, the gold in global vaults may come from a modern beneficiation plant in Accra or a hand-dug hole beside a river, and the difference in social and economic outcomes between those sources is stark. Gold matters because it anchors trust. Central banks hold it to stabilize currencies and reassure investors. As African nations expand production and, in some cases, convert output into official reserves, the continent's role in global monetary policy increases. Global reserve managers watch the flows closely. When African supply grows, it can relieve pressure on markets. When central banks buy more gold, prices rise, a dynamic that feeds back into producer incentives. Recent months have seen active central bank purchases globally, reinforcing a gold price trajectory that benefits exporters and miners alike. That feedback loop means Africa's production choices, whether to export raw ounces or invest in local refining, influence not just national treasuries, but also the stability of currencies in regions that rely heavily on commodities. National responses vary. Ghana has sought to maximize value, encouraging local processing, tightening licensing, and attempting to capture more revenue from the sector. South Africa focuses on safety, mine rehabilitation, and ensuring long-term employment. Other states, from Burkina Faso to Tanzania, balance the short-term benefits of exports with longer-term national priorities like industrialization and local beneficiation. International institutions, including the African Development Bank, emphasize governance and sustainable investment, essential to turning resource wealth into broad-based development. The AFDB's analysis underlines that mining can be transformative when revenues are managed transparently, invested in infrastructure, and linked to manufacturing. Policy choices matter. Export raw bars today, or build refineries and factories for tomorrow. Many African capitals increasingly prefer the latter. Investors notice. Private capital, from global miners to regional funds, is mobilizing. The promise of rising gold prices and stable demand draws new entrants to exploration and processing. International firms bring capital and technology. Regional investors bring a focus on local value capture and long-term presence. But the flood of capital raises questions. Who gets the concessions? What are the environmental costs? And how are royalties and taxes negotiated? In some cases, fast deals have left communities feeling excluded, prompting protests and legal challenges. In others, partnerships have built roads, schools, and energy, tangible benefits that change lives. The investment wave can be a tide that lifts all boats, or a surge that drowns the most vulnerable. How stakeholders design deals will decide which. Much of Africa's gold economy rests on small-scale and artisanal miners, millions of people who depend on day-to-day earnings. These miners are resourceful and resilient, but often work in hazardous conditions, with little legal protection and environmental oversight. Mercury use, deforestation, and unsafe pits pose public health and environmental dangers. Formalizing this sector, registering miners, ensuring fair prices, eliminating child labor, and providing safer methods, is a priority for governments and development partners. Success here can broaden the benefits of the gold rush. Failure can deepen social and ecological harm. Supporting artisanal miners is not charity. It is smart policy for stable supply chains and for ensuring that gold, which reaches international markets, does not carry a cost in human suffering. One central decision shapes the long-term price: export raw metal or refine and add value locally. Refining creates jobs and industrial capacity. It builds transferable skills and anchors revenue. It also reduces exposure to export price volatility. Countries that invest in refineries and lithium, gold processing hubs can keep a larger share of the value chain and attract related industries, jewelry, electronic manufacturing, and more. Trade policy, tariffs, export restrictions, and incentives therefore become vital levers for African nations to shift from suppliers to creators. Industrial policy must be coherent, credible, and sustained. Gold is deeply embedded in global finance, traded on exchanges, held by ETFs, and used by banks and treasuries as collateral. African production changes the supply side of that equation. If production rises and supply becomes more reliable, some price pressure may ease. If, however, supply is disrupted by conflict, regulatory uncertainty, or environmental clampdowns, price spikes can follow, creating volatility in portfolios worldwide. Recent central bank purchases have demonstrated how sensitive prices are to changes in official demand. Africa's increasing role thus introduces both opportunity and systemic risk. Financial institutions will watch political stability, contract security, and supply chain integrity in Africa as keenly as they watch macroeconomic indicators in developed markets. Beyond money, gold is geopolitical currency. Nations seek secure supply for strategic reasons, to ensure industrial inputs, reserve diversification, and even leverage in international fora. Major powers are courting African producers with investment, loans, and strategic deals. This courting can grant African states negotiation power, but it can also invite dependence if deals are poorly structured. The geopolitical stakes are high. Controlling access to critical minerals and gold can translate into leverage in trade negotiations and in the global balance of power. The new map of influence may well be drawn along mine shafts as much as along shipping lanes. In Ghana, the government has pursued a strategy of formalization and beneficiation. By tightening regulation and encouraging local processing, Accra aims to capture more of the value chain. The result? Export revenues are up, but the social contract remains delicate, with communities demanding fair shares and stronger environmental protections. South Africa's mining has matured. Its mines are deeper and costlier to operate, but its technical expertise remains world-class. Issues here revolve around mine safety, labor rights, and the future of long-term, capital-intensive operations in an era of volatile commodity prices. In Mali and parts of the Sahel, gold brings revenue and conflict risk in equal measure. Weak governance and security challenges can turn resource wealth into a source of instability. The policy task there is to secure supply while protecting communities and regions from predatory actors. Tanzania is reasserting fiscal control, renegotiating contracts to increase state take and ensure local benefits. The broader pattern is clear. African states are learning to ask for more than extraction. They ask for partnership and industrial anchors. Mining is inherently invasive without strong safeguards. Forests fall, rivers are polluted, and communities suffer. Environmental protection, proper rehabilitation, and community consent are not optional extras. They are prerequisites for sustainable development. International buyers increasingly demand responsibly sourced metals. Supply chains exposed to environmental or human rights abuses are at reputational risk. That offers an incentive. Countries and firms that adopt high standards can command premiums and secure long-term market access. The gold rush's moral test is whether this wealth is harvested responsibly for people, ecology, and future generations. Technology is changing the game. Blockchain and digital traceability schemes can verify provenance. Satellite monitoring can detect illegal mining. Automation improves refinery yields. When technology ensures that gold is traceable from pit to vault, buyers can pay premiums for certified supply, and governments can better enforce rules. The future of African gold depends not simply on geology, but on governance, data, and digital trust. For investors, Africa's gold story is a new frontier, rich with opportunity and risk. For governments, it is a chance to finance infrastructure, education, and health. For citizens, it is a potential pathway out of poverty if revenues are shared, rights protected, and the environment preserved. The essential question is whether Africa will convert raw riches into lasting wealth. The test, now, is policy, transparency, and the courage to forge industrial futures built on local value. Africa's gold is more than a metal. It is currency, leverage, and possibility. As production grows and global demand rises, the continent will not merely feed markets, it will shape them. From the mine to the market, Africa's gold rush is more than extraction. It is a test of governance, a source of empowerment, and a story that will define the next chapter of global finance. The world will watch as Africa turns dirt into dollars and gold into futures. The question is not whether the change will come, it is who will write the rules.